Hello class. I've put together this short little video to sort of set up the following videos that you're going to watch, the YouTube videos. And this week's topic is securing funding. And it's a really important topic for entrepreneurs. Oftentimes your business is going to need outside capital and supplemental capital because you don't have enough. So we're going to take you through a couple of those different scenarios. And I think the following videos, the ones after this one, are really good, and pay close attention to them. A lot of the things that are in those videos you will not be needing for the assignment later this week, which is the R&R case, but you will be needing a lot of that material and content for things in the following weeks. So make sure you pay attention and take some good notes. Okay, let's move on to the first slide. So one of the important things in getting capital for a startup is, where does the capital come from? There's various different sources of capital, and those various different sources come with different types of constraints. I would say that the easiest place to get capital is from your own bank account or from your credit cards. You might say that, gee, taking my own money and using it or running up credit card debt is not financially sound. Certainly your financial advisor would tell you that that's not a good decision. But I will also say that one of the first questions potential investors will ask you is, how much money have you put in? Because from their perspective, they're going to say, well, if you're not willing to put something at risk, then why should they? So your credit cards, your cash is a good source. And another good source is friends and family. And what do I mean by friends and family? Well, just as it describes, your parents, your brothers, your sisters, your aunts, your uncles, and other friends you may have. And you might only need $20,000 or $30,000 to launch your business, but if you can get 7 or 8 friends to each kick in $5,000 before you know it, you have that money, and you bring it in as a loan, and it's not bad. So usually money or capital from friends and family is usually pretty kind money. And what I mean by that is the terms are not draconian, and it's usually done on a friendly basis with some flexibility. However, there are those who say never mix family and business, and if that's your mindset, that's fine. There's absolutely nothing wrong with that, and a lot of people will tell you that makes a ton of sense, and so then don't go down that path. The one other thing I should say that I have not talked about here, or not put in as a bullet, is the absolute phenomenally the best way to raise capital for your startup is by selling your product. So if there's a way that you can sell your product, that's the best way, because it's unencumbered and you're also demonstrating that your product or service has value and customers are willing to pay for it. So that's the whole idea behind Kickstarter. Kickstarter is fundamentally a way of pre-selling your product or getting pre-orders for your product or service. So that's the absolute best way, and if you can figure out how to do that, that is really phenomenal. All of these other forms of capital here have some encumbrances with them. So I just did want to mention sell your product or service, because that's a great way. I'm going to talk about private equity, and I'm going to have more on the following slide or the next slide about private equity, because it's a larger topic and there's many different forms of it. So we'll dive into that a little bit more in more detail on the next slide. Of course, another category of raising capital is debt, and you can get this from a bank, or actually money you're getting from friends and family may actually be debt. They may be giving you a loan. The challenge with a bank is they're going to want that debt to be secured somehow. So what does that mean? Well, if you have a house, they might want to have the house as collateral. Well, that may make you nervous, and maybe it does, maybe it doesn't. Again, it's sort of up to you. But typically banks or institutions that do debt are going to want to have some sort of security. They may want a personal guarantee. What does a personal guarantee mean? Well, I'm not a banker, but I have signed many personal guarantees in starting businesses because fundamentally the bank's not going to make you go bankrupt. So that's a longer story. It's an aside, but debt is a big category, and it's very good. Debt is good, and you just have to make sure you have enough cash flow to repay the debt. So some types of debt are structured like a car loan. You have monthly payments, and other ones are balloons. So if you have a monthly payment, and let's say it's $1,000 a month, you just have to make sure your business is generating at least $1,000 a month in free cash flow to be able to pay that debt off. And the bank's going to want estimates from you and some good projections because they want to have confidence you can pay it off as well. A balloon payment is basically you don't owe anything. You don't have to make any payments until year 3, and then you're going to make one really big gargantuan payment. And these are, as you can imagine, a bit more risky. They're harder to get because the institution that's making you that loan is putting a lot on the table from the point of view of not getting anything and not really knowing what's going on. So they're pretty hard to get unless you have a lot of collateral. So I know there have been on houses, there's balloon mortgages that you can get, but if you don't pay it, you lose the house and the bank gets the house. So it's not like they're going to be left holding the bag, so to speak. And before we close out this slide, I just want to talk about grants. So there's all sorts of grants available. Many of these are from government economic development agencies. They might give you a grant of 10, 20, 30, 40. I've seen them hundreds of thousands of dollar grants. Sometimes they require you to put in a certain amount of money. So they may match dollar for dollar what you put in. They may put in $2 for every $1 that you put in. But grants are really great because it's a grant. You don't have to pay it back. You may have to guarantee that you're going to hire a certain number of people, you're going to have a certain number of employees, you're going to keep your business within a particular geographic area. So it does have some strings, but it's fundamentally free money. So there's a lot of those around. You got to dig and look for them. Sometimes you may need to be politically connected to get them, but they can be very good, and I've seen lots of businesses started using various different grants. So I think that's all I have to say for this slide on these various different forms, and then the next slide we're going to take a little deeper dive into private equity. So let's move on to that. All right, let's talk a little bit about private equity, because this is a big category, and I wanted to take some time to go through this because it's important. So private equity, what that fundamentally means, i.e. the word equity, is people are buying shares of stock of your company. Right? Debt is they're making debt. They don't own any of your company. They have a right to get money out of your bank account should the company fail, but they don't own any of your company. Here, outsiders own a piece of your company. So if you and your partners own 100% of it and you take some financing from an angel investor or a venture capitalist, they are going to own a portion of your company. And I'm going to talk a little bit about how that works later on in this slide, but you are actually selling ownership in your company. And along with that ownership comes certain rights and privileges. And that's what we'll talk about a little later on in this slide. But let's talk about two different types of private equity investors. One type is an angel investor. So angel investor can either be an individual or it can be a group. It's typically a high net worth individual, meaning they've made money somehow, and they want to support the entrepreneurial community in some way, and they'd like to make a little bit of money. So it's not, pure. I just want to support this. They want to make money as well. So they either get together and form groups. So, for example, up around the Albany area, there is the Eastern New York Angel Group, which is a group of about a dozen angel investors who have gotten together and decided that they will look at potential investments in companies as a group, and they'll make a group decision as to whether they will invest or not. And they all chip in the same amount of money. Uh, Angel investors also come as individuals. Again, someone who doesn't want to be part of a group, they just want to invest on their own and make their own investment decisions. And they may say, hey, look, I want to invest $100,000 in your business. So typically angels invest amounts larger than the previous category of friends and family. But again, it's almost always in the form of equity, i.e. they're buying shares of stock in your company. And angels tend to be a little bit more flexible than VCs. VCs I'll talk about in a second. Angels sometimes will take dividends in return for their percentage ownership, and then you buy their shares back at some point in time. But most of the times, they would like the company to be sold at some point in the future. So the shares of stock that they fundamentally bought, let's say for $1 a share, 5 years from now, the company gets sold and they make a tender offer and they get paid $5 a share. So that's sort of what the hopeful equation is for most angel investors. Angel investors are usually pretty good. They don't want too much control or influence over the company. Some of them are really smart business people, so they can be great advisors to you. And like I said, there's both individual angel investors and there's groups of angel investors. There's one here in Albany, as I mentioned, called Eastern New York Angels. There's one in Rochester called the Rochester Angel Network. There's one in Buffalo. There's one in Boston. There's actually several in Boston. There's several in New York City. So you can seek them out if you're trying to raise money. The next form of private equity are VCs. So VCs, unlike angels, angels are investing their own money. VCs are investing their own money and other people's money. So 10 years ago, more than that, 15 years ago, myself and 2 other people started a venture fund. So we put in some of our own money, and then we went around to pension funds, university endowments, high net worth individuals, insurance companies, banks, and we said, hey, instead of putting all your money into savings bonds, why don't you give us a little bit and we'll combine it with our own money and we will make investments in these types of companies, in these typical types of amounts, with the theory that we will get our money back plus some in 5 to 10 years. Now, when we say we'll get our money back, we're not looking for a dividend. So VCs are very, very driven to some form of exit for your company. And company exits come fundamentally in 2 flavors. One is an IPO, initial public offering. Those are pretty few and far between. They're very difficult. I actually started a company that we took public, and we got lucky, and the environment was right, and we were able to go public. In today's environment, even though it's pretty good for going public, there's no way we could have gone public today, given the amount of revenue we had, etc. But the much more common way is the company gets bought. So some other large firm, Microsoft, Google, IBM, or maybe a not so large firm, buys your company. And when they do that, they're buying all the shares of stock. And so if I'm a VC and I own 30% of your company and the company gets sold for 100 million bucks, that means I, the VC, get 30 million. So again, They make equity investments, they buy shares of stock, and here's one other really, really important point. VCs in particular, and almost always angels, buy preferred shares of stock, not common shares of stock. Why is this important? Well, oftentimes you hear entrepreneurs go, as long as I own 51% of my company, everything's fine, I'm in control. And that's true if the only shares that exist are common shares, meaning all those shares have the same rights and privileges. But VCs always, and sometimes angels, buy preferred shares of stock, which means their shares have some additional rights and privileges that come along with that. And most of those additional rights and privileges give them a disproportionate amount of control and influence over your company as compared to their percentage ownership. So for example, they may only own 30%, but they get 2 seats on the board. They may only own 30%, but you cannot do a whole long list of other things without their permission. And we will actually have a whole week that we're going to spend on term sheets because these are really important. A term sheet is a document that defines those rights and privileges that come along with preferred shares. So we'll dive into that in a little more detail, but for now, the takeaway is angel investors most of the time, venture capitalists all the time buy preferred shares of stock, and that gives them extra rights and privileges. So let's talk about a couple of other things that are going to go along with if someone is buying shares of stock. Well, one of the things you need to do is you need to figure out how much a share of stock is worth. So let's say you and your partners started a company 2 years ago, you raised some money from your own bank account, your friends and family, and somehow you've come to the agreement or notion that your company is worth $3 million today. We're not going to go into how we determined it was worth $3 million. We're just going to say it's worth $3 million. And let's say you want to raise $1 million and you're looking for $1 million to fuel the growth of your company. So the way that we would figure out valuation is the simple equation. Assuming you have agreed with a potential investor that they agree to a $3 million valuation and you agree to them taking or selling or buying, you agree to sell them $1 million worth of your shares of stock at a $3 million, what would be called a pre-money valuation. Pre-money meaning this is before their investment. So how would we figure out what percentage of the company they buy? So the equation is pretty simple. This is a simple division. It's the amount invested divided by the pre plus the amount invested. So in this case, we said they were going to invest $1 million, divided by the pre-money valuation, which was $3 million, plus the $1 million they invested. So they're going to buy 1/4 of the company. So they're $1 million, going to buy 1/4 of the company. Now you're saying, well, wait a minute, my company's worth 3. They're giving me $1 million. So wouldn't they buy 1/3 of the company? Well, that would be true if they were giving you personally that $1 million, but they're not. They're putting that money into the bank account of the company because you want to use, or the company, I should say, wants to use this money to fuel growth. So the logic goes something like this. The second before they made that investment, your company was worth $3 million. So that's, the intellectual property, the buildings, the employees, the products, the revenue, all of that stuff you decide is worth $3 million. 1 second after they made the investment, your company's still worth that $3 million, plus you have $1 million more in the bank. So the value of the company has to go up by another $1 million. So 1 second after the investment, the company's now worth 4. And that's the piece of the company they bought. So they're buying the company at the moment of the investment, which includes that $1 million they're investing. So if that money's going into the bank, then yes, indeed, the equation I wrote down here works perfectly. If that money's going into your pocket, then it goes back to the sort of what most people think of logically is, well, wait a minute, my company's worth 3 million, I'm selling them $1 million a share. But you personally are not selling them, it's the company that's selling them. So that's the logic. So in this case, they would be buying $1 million, would buy a 1/4 or 25% ownership of the company. So that's important. And so that's the equation and the logic that goes behind it. I hope you understood that. If not, send me a question in the forum and I'll try to explain it a little better. And some of the videos that you'll be watching here will also go through an explanation of that. So a couple other things that are important to go along with this. One is a liquidation preference. And this is always a key parameter. And I'm just going to say a little bit about it because we're going to spend more time on this when we talk about term sheets. But liquidation preference basically says that when the company gets sold, the preferred shareholders get to take their money out first. And then everyone, including them, including the preferred shareholders, divide up the rest of the money. So they sort of get their money out first. So one way to think about this is, let's say this VC invested $1 million in this example we just did, and you said your company was worth 3 pre-investment, and so 4 post-investment. They own 25% of the company. They invested $1 million, and let's say that things didn't go well with your company, and 2 years later, your company gets sold for $1 million. Now, let's say it gets sold for 2. Let's do a better example. Let's say it gets sold for $2 million, and the VC has a 1x liquidation preference. Don't worry about what the details of the 1x for now, but it basically means they get out 1 times their money first. So the company gets sold for $2 million. The VCs, and you would say, okay, they own 25%. So fundamentally, if they own 25% of a $2 million company and it got sold, then they would make $500,000 or 500,000. That's 25% of that, I think, right? Of 2 million. However, they had a liquidation preference, which means, well, wait, before I go to that. Now, in this scenario, they get 25% of the 2 million. They lost $500,000. That didn't go well for them. So what they're saying is, we have this liquidation preference, which means we get our $1 million out first. So out of this 2 million, they're going to suck down $1 million. That leaves 1 million left over. And then now the VCs and all the other shareholders are going to divide this $1 million up. So they're going to get 25% of that. So they're going to do 1 million plus 250,000. So here they make 1.25. That's liquidation preference. Bazinga, as they say. So you might say, hey, that's not fair. Well, the VC view of this is the following. When I invested in your company, you told me this is going to be a great company and we're going to sell it for 20 million bucks or 50 million bucks. So I believed you. Well, that didn't turn out. So, hey, that's not right. So in that case, I need to make sure I get my money back. And the saving grace here, if you can think of it that way, is let's say you would have sold your company for 20 million. Then actually, usually these liquidation preferences have a cap on them. So if the company gets sold for amount above a certain amount, the liquidation preference goes away. And even if it was still here, the liquidation preference here doesn't make that huge amount of difference. If we do it without a liquidation preference, 25% of 20 million would be $5 million, I think. Let's say there was no liquidation preference. And with the liquidation preference, you would suck out the million first, so there would be 19 million left, and then they would get 25% of that, which I can't quite do the math in my head on that, but it would be 4 something. So they would get more, it'd be 8, let's say. So they do get more, but it doesn't impact the rest of the shareholders as much. So enough on liquidation preference. We're going to dive into that a little bit more, but it's a very, very important parameter, especially for entrepreneurs to understand. So if you have a suboptimal exit, you're going to get whacked. And remember, back in this example over here, where we said the VC is getting 1.25 million. Well, in this case, that only leaves 750,000 for the the other shareholders. Oh no, yeah, 750,000. Wait a minute, it got sold for $1 million. They got 1.25. That's no, it got sold for 2 million. Let me rephrase this. It got sold for 2 million, right? So it's another 750,000 left over for the common shareholders. Where in this case, if there wouldn't have been any liquidation preference, the common shareholders would have got 75% of 2 million, which is 1.5 million. So there's a big difference there, right? And that extra that went into the venture capitalist pocket all came out of the common shareholders, or you, the founder. That's why it's important. Okay, one other quick thing. Other investor rights, I talked about this a little bit, but with preferred shares, let me try that again. With preferred shares will come additional rights, board seats. You can't do certain things without the shareholders' permissions. And again, we'll dive into all these a little later. So let me close this slide out. It's gone on long enough. And let's get into the last slide. So as an entrepreneur, what are some things that are really important to you to understand, in addition to the things we talked about? Know what you want. So these are some key points as an entrepreneur. Know what you want. Do you want to be king and in control? Then that takes you down certain paths, right? Takes you down debt, maybe angels if they can be friendly, but it's going to be debt, friends and family, and grants. So if you want to be in control, i.e. in control and being able to make all decisions, then it takes you down a certain path, or your own cash, for sure. And however, if you want to grow your business as fast as you can, or you're in a business that just needs a lot of capital, there's certain types of businesses that you need to have millions of dollars of money in order to build the factory or to build your product, to do the research and development. So you don't really have a choice. So in that case, you're bringing partners, and think of these as partners. Think of investors as partners. You're bringing partners into the ownership of your company. And the challenge there is you just may be a passenger on that bus. You're not driving the bus anymore. If you're doing a good job and things are going as they should, everything's fine. But most of these extra rights and privileges that investors put in there, venture capital investors put in there, are there to give them control when they don't think things are going well. It's also important for you to know what the investor needs and wants. So if you're negotiating with a venture capitalist, don't tell them you're only going to take debt, because that doesn't happen. It doesn't exist. So you have to understand what their needs are. And in the same way, a bank's not going to invest in shares of stock. They don't want shares of stock. They want debt. So understand where the lines are rigid and understand where the flexibility is. So for example, with a venture capitalist, they're going to buy shares of stock, but there may be flexibility on the valuation. Maybe you can negotiate that, hey, you know what, instead of my company being worth $3 million pre-money, it's worth 3.5 or 4. Well, what does that mean? Well, that means you're going to be selling less of it to them for that $1 million. So understand where the flexibility is, understand where there are rigid lines, figure out what's important to you, and make sure that's really clear in your head as you go to think about where you're going to raise capital from. So I think that's it for this section here. The other videos are really good. Hope you enjoy them. And again, any questions that pop up, send them to the forum. And I think that's it.